Hello and welcome to this closing keynote panel here at the Soonicorns Summit. I'm Aloni Bhatt. With over 75,000 registered startups, India certainly has one of the most vibrant startup ecosystems, emerging as the third largest globally. But how do you build great world-class companies? Those with solid business models that are profitable, sustainable, that create jobs and make their mark globally. What will it take for us to enable these super enterprises from India? That's the focus of this session. And I'm very happy to have with me Lavanya Ashok, partner Trifecta Capital, a venture financing platform with products spanning growth equity, credit, and financial advisory. Lavanya, welcome.
Thank you.
We have with us Sanjay Swami, managing partner, Prime Venture Partners, an early stage VC fund. Sanjay, very good to have you here.
Thank you. Great to be on the show.
Next, we have Pankaj Makkar, Managing Director, Bertelsmann India Investments, a sector-agnostic venture capital fund that mentors growth stage companies. Thanks for being here, Pankaj.
Thank you very much. Really good to be here.
And finally, we have with us Amitabh Nagpal, Head, Startup Ecosystem, India, AWS. Amitabh, welcome.
Thank you very much for having me here.
All right. I'd like to start with you first, Pankaj. There's a sharp drop in PEVC investments right now compared to the same time last year. There's a pullback in liquidity. From early stage to late stage investments, there is uncertainty leading to rationalization. Deal values are smaller. Deals are taking more time to go through. More compliances are being asked. The frenzy, of course, seems to be over. But the India story, we're assured, is deep and vibrant. Can you highlight for us the strengths that work in India's favor?
I'm happy to do that. And I'm glad that you asked the question. For us, the India story has been and will continue to be a fairly strong one. And that's kind of backed by the strong macroeconomic tailwind that India enjoys. We are the fastest growing large economy in the world. And the most of the world is actually looking at India as one of the forces which will kind of deliver global growth. And that is extremely true when you look at kind of startup ecosystem as well. The second thing is, in general, we feel that the startup ecosystem in general has matured to a level where significant amount of activity can happen despite global issues coming in or out that ideally should not affect the startup ecosystem. It's kind of matured to that effect, and it's a good place to be here.
Okay. Anyone else wants to add to that?
Yeah, I think, just peeling the onion back a little bit as well, right? I think we have a lot going in our favor in India that makes it a very attractive market for global investors, looking at places to invest. First of all, I think China is no longer seen as attractive an opportunity for a variety of reasons, many being geopolitical and as well as other reasons. And so that is in our favor. The second is, of course, the young population, which is a very digitally savvy and very hungry population, right? And if you have seen with UPI as a great example, the willingness and the ability to learn, new technologies and adopt new technologies, right? So if you think about it, the US or the West in general was, economically very successful before the internet came and sort of they leveraged the internet to take things to the next level. China kind of built its economic wealth, alongside the internet, so to speak. But in India, I think the internet has come and has reached scale and will in many ways become the platform on which the GDP growth and economic wealth is going to happen, right? And so we have no choice but in India but to adopt digitization, to make sure that we can deliver services at all levels, whether it's fintech services, commerce, what have you, education, and now healthcare as well. And agri is also starting to digitize. And the whole theme of digitization is going to be driven largely by the startup ecosystem, at least initially, right? Because that's where the innovation is bound to happen. So I think a lot of other factors combined with the geopolitical factors make India both a very attractive destination for capital as well as for consumption. So I think there's just a lot happening here that makes this sort of a perfect storm. And while in the short run there might be a lull as the markets sort of stabilize and so on, I think this is it's just a point in time, and this ecosystem is going to get come roaring back even more strongly.
So it's an attractive ecosystem, Sanjay, and it is a lucrative ecosystem for VCs as well.
Absolutely, no question about it. Right? Because see, venture capital is something that we look at a 5 to 10 year horizon, right? So it's true that if you look at any economy over a 10-year period, there will be some bad times in between, and these are always moments to when sort of an engine is overheated. You have to sort of slow down a little bit, take stock, and then you just can't be driving at in sixth gear all the time. You have to slow down every now and then. And we are in that moment, right? Right now, there's no question about it. But I think the companies that are formed now, or all the existing companies, I was just at a board meeting for one of our growth stage companies, they're all going to actually become much more healthy, much leaner. And sometimes a lot of capital hides a lot of bad things in the companies, right? And this is a moment for companies to realize that capital doesn't come for free or not that freely, and so they need to actually tighten the belt a little bit, give up some of those bad habits and prepare themselves for the next sort of 5 years of growth. And so it's really not a bad time because there is no pressure to just grow at all counts.
Okay. Yeah, Meloni, I'll add to that. Fine. So, and see, I have a lens of entrepreneurship of India as well as other regions. And I've been an entrepreneur in India. I've raised from 2007. And one thing that if you look at over from 2007 to now is that the quality of the Indian entrepreneur actually has gone through a huge maturity. The ability for them to look at moonshot projects, to think globalization, to think about products has actually exponentially increased. Fine. And fundamentally, if you look at it, the horse that everybody rides on is the entrepreneur. Fine. If the quality of the entrepreneur just goes through the maturity, what we've seen in India, and you look at some startups that have come up in the infrastructure space now, I can tell you that 8 years back, 10 years back, 15 years back, nobody had the audacity to even think. So what entrepreneurs today think in India is very different than what they thought 10 years back. And to me, that's the maturity, fine. And then there have been other things like Indian ecosystem has started seeing M&As, they've started seeing exits, they've started seeing they've started actually talking about between companies mergers, fine, which didn't happen. So all these are actually signals or intrinsic factors that talk about the Indian ecosystem.
Right. I'd like to just jump in on that as well with a couple of stats, right? Just to illustrate what Sanjay, Pankaj, and Amitabh were all discussing, which is 2021 was really a record year for venture in India. It grew almost 4x from 10 billion in 2020 to 38.5 billion if you take venture and growth for tech. And so some slowing down was inevitable. But if you just look at the dry powder waiting to come back in, that's estimated to be like 50 billion. Right? So it can wait 6 months, 8 months, 12 months, but it's going to come roaring back to this ecosystem. And so I think long term, that's why a bunch of us, are still here doing the work, evaluating the companies and imagining what the future could look like.
Yeah, but there's another challenge that exists in the startup ecosystem, and which is the high failure rate of startups, right? So, while you have the VCs investing in the Indian market, can you give us a sense, Lavanya, of what would be the failure rate, if you compare that to other countries, say China, say US?
So Miloni, I'll just explain this failure rate a little bit using, what is just the most pervasive rule that has stood the test of 7 decades of venture globally, right? Which is the power law. And what simply stated that says is a small number of companies will deliver disproportionate value for what is defined as early stage venture. Now, as you go down the spectrum to growth, to late, to public markets, those same companies will give different investors very different return profiles. But in what is defined as early stage venture, it is a hits business. You will have those 1 or 2 companies in every fund that return the entire fund. And that is by design. Because, Khosla has famously said, right, that you can lose 1x of your capital on a particular deal, but you can make 100x, and that can return the entire fund 4 or 5 times over. So I think failure rate is to be seen in the context of overall fund performance. And anecdotally, in preparation for this panel, I was just speaking to a few VCs who are cross-border, right, who have a presence in India, who have a presence in the US, to get a sense for relative failure rates. And I think what comes out pretty shiningly is that if you look at total value to paid-in capital, which is, what the fund is worth, not necessarily what has been returned to investors, it's pretty similar if you look at the US and if you look at India. But if you look at actual liquidity and if you look at actual dollars removed and returned to investors, or what we call as DPI, that is lower. And that's some of the things we discussed earlier on this panel, which is exits have been a little long coming. But now that the public markets have proved that for quality assets, the door is open from the tech ecosystem. We've seen large transformational M&A. There's a bunch of internal M&A within the country that we're seeing that's, truly come of age. I think the catch up of that DPI, TVPI is likely to be good in the coming 5 to 10 year period.
All right, so it's all, as we said earlier, a maturing of the ecosystem, and as it kind of matures more and more, all of these things will kind of fall into place. Amitabh, I want to go to you next. In the backdrop of this funding slowdown, where are we seeing, or in which sectors are we seeing the interest change as far as the VCPs go? Is there a revival in investments in hard assets, like say an infra or a retail? Which are the other sectors that are looking attractive?
Yeah, so I'll answer your first question also about the risk in a startup. Fine. So if you look at and startups fail, I think startups fail because when you start a startup, there's totally ambiguity. Fine. This is something that the entrepreneurs are doing, that something has never happened. Fine. So startup starts by basic assumptions that the world is going to change. The world is going to behave like this. So the startup founders are able to see 2, 3, 4, 5, 6 years, connect the dots and say, these are industries that are going to change by this way. And it's a set of assumptions. And if those assumptions get true, like Lavanya said, the returns will be disproportionate. Fine. So, when people talk about a failure in a startup, it's not true sense of failure, it's a learning. And that learning is actually very experiential. If you look at founders that do a startup and then they have a learning and then they fail, then they come back, are actually the most prime candidates for investors to go back and invest. Fine. And I think that should be encouraged. And the reason I'm saying that is, even from a media world, failure of a startup is not a very negative thing. Fine. And I actually mentioned that everybody climbs Mount Everest and comes back. It's not necessary to touch the peak. You always have the next time, and you can actually then go and climb Mount Everest. Now, your second question is, which areas are actually seeing, I think, positive. Fine. So if you look at this time, the fundamental economy, fine, there are many things going on. There is inflation going on. There is increase of interest rates that are going on, and there is war going on. Fine. So, but at the other end, I think Lavanya also mentioned that there's enough gas lying for people to invest in. I think money will come in. You are still seeing the early seed stage investing happening. because the cost of investing in seed is not much. And it's true, and time has been a proof of that, that some of the best startups will actually come and get created right now, because costs will get controlled, talent availability will be very high. Fine. We are still seeing a lot of stuff in gaming. I think there are enough problems to solve in health in India. Health is very big. You are also seeing some things in logistics and mobility, and fine. So these are areas that are growing, but early stage investing is not declining that much. It's taking time to raise capital. The valuations are getting a little better, but the cleanup of a startup ecosystem happens in every country. Fine. It happened in 2000. It happened in 2008. It's going to happen now. I think these are good cycles to have, and they bring in a little bit of basically honesty, and you are able to look at what can happen. So that is what I think is happening right now.
Yeah, a step back, review, and then sort of focus on building, and then come back really strongly.
Yep.
I want to talk on the early stage investing that you mentioned. All of you are in this space. Pankaj, earlier this year, BII announced a $500 million fund for Indian startups, and also said that it would be looking at investments in early stage startups. You are known to invest in the mid series, the series
Yep.
B, C's. Why is this? Why is money moving downstream? And why are firms shifting focus towards early stage segment in India?
So I think
as an early stage fund, I have the same question for you, Pankaj. Why are you coming into the early stage?
Because we get inspired by people like Sanjay is probably the good answer, and we want to come there. But honestly, our thesis is that, and something that we kind of spoke in the show earlier, that the ecosystem has matured enough on both counts, the entrepreneur's quality as well as their ability to build businesses with a little bit of capital, and hopefully remove a lot of the binary risk which earlier used to happen probably 7-8 years back, which would take a lot more capital to kind of to take away. Now, from that perspective, if we look at the ecosystem, we feel that coming in as little slightly early, we probably are taking the same amount of risk, but may be able to deploy our capital over a larger number of companies, which kind of makes a lot of sense. And honestly, and full credit, to Sanjay and all the early stage investors. They've done a fabulous job in mentoring a lot of entrepreneurs who today are are dreaming about building extremely large outcomes, and that is the real answer why we are excited about coming in a little early.
Okay. Sanjay, to you next. Prime Ventures Partners recently closed a $120 million fund for their fourth fund. And, you seem to be unfazed by the ongoing economic downturn, the price correction in tech stocks in the public markets. You're committed, it seems, to closing at least 6 to 7 new deals this year in early stage startups.
Mm-hmm.
Can you tell us a little bit more about this investment strategy? And, how come this ongoing economic downturn, according to you, is not a period to get faced?
Yeah. So, and I was just kidding, of course, with Pankaj, we know each other very well, and hopefully we'll do some things together. But, I think, Maloney, I was India's first fintech entrepreneur, literally, right? I mean, I was the founding CEO of a company called Mcheck before Paytm, 4 years before Paytm, and we were a bit too early. And after that, we've had EasyTap that just exited to Razorpay. We've had HapPay that just exited to Cred, and several others in this space. And we've always been, the first institutional investor to work with founders. Whether it's a company like MyGate or a company like WheelsEye or Neo or what have you. And it's an area where we believe that. Regardless of what's happening at the macro levels, innovation will actually come from people who see problems and understand these problems extremely, extremely well. And in our case, see software and technology as a means to solve these problems at population scale, right? Population might be of that problem that they're solving, but at that kind of scale, right? And these opportunities and ideas come when they come, right? It's not like they only come during good times. In fact, people who are passionate about these problems actually have the conviction and the courage to step out during these not so exciting times. Because if you think about it, in building a company over 7 years, there is bound to be some economic downturn somewhere along the journey and some hiccups, right? So it's actually the best to get past that very early in your life as a company, so that by the time these products are robust and mature and tested and a proven product market fit and a proven distribution and a proven business models, the growth, things are looking up, and the growth stage investors are going to be more active, right? So this is actually the best time for founders to be able to step out and try to build companies, right? There are also a lot of other dynamics that work very well right now, right? Because there isn't a lot of follow-on capital easily available, companies will have to be built right? They will have to focus on using the limited resources that they have, and not buying growth, but actually, establishing themselves, establishing their business models, their unit economics, and their go-to-market and the value proposition, right? So we actually think, and I think one of the other panelists alluded to this earlier, this is absolutely the best time to get in at the ground floor, right? And the pressure on founders as well, right? The growth at all costs, the high cost of hiring software engineers, the high cost of having been forced to do IPL ads to show the traction and stuff, like all of those are out the window. Now you can just focus on what the Americans call meat and potatoes part of doing the business. Just get the basics right, do the right things, do it in a frugal manner. Entrepreneurship is not meant to be easy. It is meant to be difficult, right? Otherwise, everybody would have done it, right? But if you prove the right things and prove that what you are building is an aspirin and not just a vitamin for people, right? Solve all these issues, then come to the second half of 2023, hopefully when things start looking up, these companies will be really attractive because they're robust, ready for scale, and the growth stage investors will be back at the table. So from our perspective, sorry for a long answer, but this is why this is absolutely the best time, right? And in any case, we typically we're very selective. We do 6 to 7 deals, even in a good year, right? So even in 2021, we didn't do anything different. And so our philosophy remains the same, to do 6 to 7 new investments, and we are already well on track for that this year.
All right. Okay. Lavanya, to you next. Trifecta Capital has a venture debt fund and a growth stage equity fund. In an interview, I think earlier, the firm said that it's not taking a timing bet on when IPOs materialize, but it would invest in companies which are targeting liquidity in less than 3 years. As this equity route is narrowing in India, compared to say 2021, 2020, do you see an increase in demand for venture debt?
Absolutely, and great question, Miloni. And I'm glad we said that earlier, because we're being proven right to not be taking bets on timing. We wish it hadn't happened this quickly, but one cannot perfectly time these things. The reason on the equity side we didn't want to take that bet on timing is because we've been doing this now for 2 decades, right, as a GP. And we've seen that things rarely go as per plan A. Windows of liquidity open and shut. What is in your control is your preparedness to go and access a permanent source of capital as a founder and management team. Now, that preparedness is something we check for as a growth stage investor. And that preparedness within a 3-year period is an important part of our underwriting thesis. Now, the IPO may happen in 1 year, it may happen in 2, it may take 4, it may take 5, right? But the preparedness to say, my house is in order, I have the processes necessary to be a public company, I'm comfortable with the cadence of quarterly reporting, I'm open for retail investor scrutiny. All of these things are what we check and then we help with post-investment. Now, you asked another very interesting question, which is, given equity seems to have gone back a little bit, is venture debt more in demand? And I think I have a nuanced answer for you, which is venture debt has always been in demand because in general, if you size venture debt relative to venture equity, it is somewhere in that 15% type zone. And in India, the market is not as large. So if equity was, say, 10 billion, in 2021 for just 2020 for venture. Venture debt should have been 1.5 billion, right? But it wasn't that large. So the room for startups to consume venture debt is very high still. But what is interesting is larger startups that traditionally would have preferred to take lower cost financing from a bank in the form of a credit facility, in the form of term loans, in the form of receivables financing, may not get that in this environment at the desired rate. And so we're seeing more and more mature businesses come and say, I'd rather not dilute now when equity is expensive. I'd rather take some venture debt, which still on a relative basis is a very attractive dilution protective product for me as a founder. So that's the sort of nuanced answer. And on the growth equity side, Meloni, we're still seeing a lot of demand because a lot of global funds that did not have boots on the ground in India that were doing growth equity investing have retracted a little bit. Part of the reason is the public portfolios have shrunk a lot because that's mark to market daily. The private portfolios look very large in relative comparison, and therefore they don't want to take more private exposure now in emerging markets at the growth to late stage. And so that's a larger portfolio construction issue, right? Which will get corrected as markets rebound over time. But given that our domestic capital is now being seen as very attractive to founders. And so I have had so many founders reach out to say they'd love to consider, a smallish round. In some cases, off cycle, because they may have planned to raise, 6-12 months hence, but they feel if they raise a slightly larger amount now, they can push out that larger fundraise event to when they are sort of in a position to come and, ask for price.
Right. Okay. But, I have an offshoot to this question, and that is that, the active investor base in India is also seeing a significant expansion, right? Like it's reached what, 660 odd plus from a base of 500 odd in 2020. Now, several seed funds and family offices have debuted or raised funds for early stage rounds in 2021 or in 2022. Could be promise of large returns, diversified portfolio, which has spurred interest. And that is only growing as new generations take charge, with an eye for latest tech innovations. Lavanya, if you want to take this question, and then, Sanjay and Pankaj and everyone else can kind of chime in. Are you seeing family-run offices having a strategy or structure in place, or do you see, their push driven by FOMO?
So, Meloni, I think globally, the wealth creation at individual and family levels has been unprecedented in the last decade, right? And so you are seeing a very new type of LP, as well as some interesting new GPs come to the market. In India, we're definitely seeing a lot of family office activity. And I divide that into two parts. One is where they want to institutionalize, where they go and hire a talented investment team and try to do this entirely themselves. And the other model is where they come in as LPs into a bunch of existing funds and try to co-invest alongside them, such that the manager becomes one big source of evaluation and investment judgment. And through that, they learn about what is a family, their risk appetite is, what they feel more comfortable doing directly, and can then double and triple down exposure over time. So we are seeing a lot of new activity on the family office side. We welcome that. 30 of the 50 largest Indian families are LPs with Trifecta Capital. So we find that to be a very interesting new source of capital formation in the country.
Sanjay, what do you think? Do you think that, it's great for all of these people to be able to invest in companies, to believe in that idea of India and sort of really make a push to have enterprises which they believe, could be big companies in the future. But do you see that, are they coming in with a strategy, or, what is it that's pushing them into this space?
Yeah. So as a fund, we've primarily raised from exclusively from overseas LPs so far. That might change in future. But what we are seeing and what I'm seeing with peers in the industry, One thing is there is a lot of new wealth that's been created, right, from the startup ecosystem itself, right? So there are a lot of people who believe, because this is how they created their wealth, and who want to funnel that back into more a interesting way of both giving back as well as multiplying their wealth as well, right? So that's one group of investors who are people really from this new age entrepreneurship ecosystem themselves, right, as entrepreneurs. The second is, I think, large family offices that have had traditional businesses that might be disrupted by new age, right? So healthcare providers looking at health tech companies, and they want to be a part of it because they need to understand what's going on, and they may potentially, these might end up being M&A opportunities for them, or even otherwise just sharing in the upside. They may also be able to forge strategic partnerships, which is great for the startups as well, because they can then distribute, they get distribution through these incumbents, and it's a healthy sort of win-win partnership, right? This could be no different from, say, a bank investing in a fintech, for example. The third, I would say, are things that Lavanya said about just coming in as LPs, directly investing into companies, because I think it's now seen as a first-class citizen when it comes to being an asset class, right? It's no longer that esoteric thing that 4 or 5 companies are doing and that we don't understand. It is so material that I need to understand it, right? And part of it is tuition fees, trying to understand, and that's where working with LPs directly, and part of it might be, there might be a small amount of FOMO, but I don't think that that drives Indian investors at scale.
Okay, all right, good to know. This is my last question now for all of you, and Amitabh, if you could take the lead on it. What do you think the next 10 years look like for the Indian startup ecosystem? Foundationally, have we been able to put in a strong system for it to flourish, and what should be the focus over the next decade? Amitabh, you first.
Yeah, I think if you look at globally, fine, innovation is never going to stop. Fine, fundamentally, ability to innovate, fine, has become so cheaper. And today, with a lot of things like compute becoming cheaper, what you can do on innovation, that it's going exponential. That's one end. The second end, as I said, the maturity of the Indian entrepreneur again has gone through the roof. Fine. Today, global investors are looking at India. An Indian entrepreneur can start in India and expand globally. It's like there are startup founders who within a year or 2 years have a global ambition and they set up an office in US and come fine. Third, all the money that has gone in, look at the training that money has done to create people with a product mindset, teaching them what product market fit is, fine. For all of us who've run products and between the valley and here, it takes resources and money to teach people what product market fit is, how do you go about creating a product, how do you take assumptions, fine. So that is the training that's happened already. And it's been established that wealth can be created. It's the M&A. So the ecosystem is right, fine. I think next 10 years is going to be something that we all haven't seen. I think it's going to be at a very different curve. Really large global companies will come out of India. High quality entrepreneurs will get created. Fine. So it's kind of a flywheel that gets established, and I think that's where we are as an economy.
Okay. All right, Pankaj. If you what's your view? We have to build companies that are profitable, but we also have to build companies that are sustainable over the long term. What will it take for us? What are the the guardrails that we need to have in place for us to be able to achieve this? Pankaj.
So I think, first of all, as a country, there is significant amount of inefficiency in our country that still exists, and that we see that as inefficiency as large opportunities. We have an extremely large market, and therefore building products and services for this large market as India is one topic, and then building Indian companies to the world gives us massive amount of opportunity to build extremely large, hopefully profitable and sustainable businesses. Now, at the end of the day, what we have to keep in mind, given that the opportunity exists and there is enough money on the around the table to kind of back some of these companies, is to make sure that we build businesses which, number one, have the right to exist, but also we have the right to win in those categories. And hence, building a business in a sensible fashion and not just building it by virtue of discounting, etc., is something that we should keep in mind. Now, if there is a category which is a winner take all category, we can understand that you're trying to build critical mass in that business because network effects eventually will take place, etc., etc., and hence some amount of discounting is okay. But if there's a category where multiple players have to exist, you should not be going down the path of doing massive discounting, etc. So those are the kind of things that we talk to entrepreneurs about when they think about building their businesses. And I think that's the caution I would kind of give to the entrepreneurs, that listen, think of what business you are in, think about what is the right amount of capital that is needed to build that business, and deploy that strategy. And there is no one strategy fit all type of solution available. Depending on which category that you're trying to solve for, what inefficiencies you're trying to solve for, it may take either very little capital or a lot of capital, and hence you need to kind of think about it in that fashion.
All right. Sanjay, what's the advice you give young startups, taking off from where Pankaj has for us?
Yeah. So, neither venture capital nor entrepreneurship are get-rich-fast schemes. I think founders have to take the long-term view. I had the privilege of also being part of the original Aadhaar team and then been very involved with India Stack and UPI. I think opportunity-wise, India is going to not just be a great opportunity for people to innovate in, but I think a lot of the solutions from India will be very unique. And as we're seeing with UPI starting to be adopted in other parts of the world or accepted in other parts of the world, I think founders who focus on solving the right problems and solving them right in India will have not just a monster opportunity in India, but in other parts of the world as well. But there are no shortcuts here, right? Yeah. I think I'm glad that this year, through a series of a few unfortunate incidents, has thrown the focus back on, compliance and doing things right. We have a tendency to take some shortcuts when we see, whenever there's an opportunity. And I think that is something that will probably people will get very strict with here in India. But these will build robust companies, right? So I think as long as founders are building things in a patient manner, sometimes you need to slow down. When you're driving a car, you do sometimes need to go back to second gear or first gear just to come back stronger, right? And a few extra stops at the gas station to raise a little bit more capital is not the end of the world, provided you get to your destination in a healthy manner. And a lot of analogies around driving. And I think founders who take the long-term view and the patient view of solving the problem with conviction will do very well here. And that's really what we're looking forward to as well.
Okay, Lavanya, you have the last word.
Wow. So just this morning, I was reading McKinsey's global CEO, Bob Sternfeld, saying it's not just India's decade, it's India's century. So I woke up with a big smile on my face, because we all know those McKinsey guys are really smart, right? And if their CEO is saying it, I am hoping and praying it must be true. And I think one of the really interesting things in that sort of report was, by 2047, we are going to have 1/5 of global workforce in India. So if you think about what you need to succeed in venture, you need ideas, you need money, and you need people. And I think the talented workforce is here. Like, we are building in Bharat for the world, Miloni. It's happening, right? It's just a matter of accelerating that smartly, but it's happening. And I think we've always been an ingenious nation, right? There's no shortage of ideas. I think I fully resonate with all the points around discipline made by Pankaj and Sanjay in channeling capital to the best possible ideas, and then entrepreneurs using that capital to go and execute to this very large opportunity, right? If you look at our, per capita GDP at $2,200, this truly could be that golden decade where it accelerates, right? And be it, this transformation of public good to private enterprise, in education, in healthcare, in energy, we're seeing transformation all around us in a very real way. And we're seeing that trickle down, right? We're building in Bharat for the world, but we're also building in Bharat for Bharat. And I think, that just gives me immense joy to, in some small way, be contributing to this, very exciting phase in our industry's evolution.
All right. Well, Lavanya, thank you so very much. Those were very good and strong and, encouraging words to end this panel discussion. As you said, we're building in Bharat, building for India, building for the world. And, as the other panelists said, we need to do it with all the compliances in place. We need to be profitable, but we need to make sure that we are sustainable in the long term. Thank you so very much, all of you, for joining us. Lavanya Ashok, partner, Trifecta Capital. Sanjay Swami, managing partner at Prime Ventures. Pankaj Makkar, managing director, Bertelsmann India Investment. And Amitabh Nagpal, head, Startup Ecosystem India, AWS. Thank you very, very much for your thoughts and for your time today.
Thank you, Meloni.
Thanks, Meloni.
Thank you.
Thank you very much.
Thank you.
Bye-bye.